Saving and investing are critical components of financial freedom and creating wealth steadily, but not all investment options are beneficial to you. While some avenues offer the potential for growth and financial security, others come with significant risks that could lead to substantial losses. So, here are 4 places where saving or investing might not be the wisest choice. 1. Non-interest-bearing savings accounts. Traditional bank savings accounts often fall into this category as they have long been a popular choice for individuals looking to keep their money safe and accessible. These accounts offer a convenient way to store funds while providing easy access to cash when needed. However, their primary drawback lies in their lack of interest-bearing features. With interest rates at historic lows in many parts of the world, the returns on non-interest-bearing savings accounts are often minimal, failing to keep pace with inflation. As a result, the purchasing power of the money held in these accounts may gradually erode over time, effectively diminishing the real value of savings. Moreover, in today's financial landscape, where inflation rates can outstrip the interest earned on traditional savings accounts, relying solely on these accounts for long-term wealth accumulation may not be prudent. While they serve a valuable purpose as a place to store emergency funds or short-term savings, they are not well suited for achieving long-term financial goals. Investors seeking higher returns or a hedge against inflation may need to explore alternative investment options, such as bonds, stocks, or real estate, to ensure their money works harder for them over time. Ultimately, while non-interest-bearing savings accounts offer security and liquidity, their limited ability to generate meaningful returns makes them less than ideal for investors looking to grow their wealth over the long term. 2. Stashing cash under your mattress. The idea of stashing cash under your mattress or elsewhere in your home is a strategy that some individuals adopt out of a sense of caution or distrust in financial institutions. While it may seem like a secure way to safeguard your money from economic uncertainties or potential banking system failures, this approach carries numerous risks and drawbacks. Firstly, keeping large amounts of cash at home leaves you vulnerable to theft. No matter how well hidden you believe your cash to be, it's always at risk of discovery by burglars or other nefarious actors. So, even if you have insurance coverage for theft, the emotional distress and inconvenience caused by a robbery can be significant. Another critical consideration is the impact of inflation on cash stored at home. Unlike investments that have the potential to grow over time, cash kept under your mattress does not generate any returns. As a result, its purchasing power diminishes over time due to the erosion of inflation. What may seem like a substantial sum today could be worth considerably less in the future when adjusted for inflation. Therefore, relying solely on cash stored at home as a long-term saving strategy may leave you vulnerable to the gradual loss of wealth over time. 3. Investing in stocks recommended by celebrities. Investing in stocks recommended by influencers or celebrities is a practice that has gained popularity with the rise of social media and the influence of personalities across various platforms. I don't recommend any of my subscribers or views on any particular stocks to invest in, as I know that investing needs one to do their own research on what stocks fit them as investors and the level of risks they are willing to take to invest in a particular company stock. While it's natural to be swayed by the endorsement of someone with a large following or perceived expertise, it's crucial to approach such recommendations with caution. Celebrities, despite their fame and influence, may not possess the necessary financial expertise to provide sound investment advice. Their recommendations could be driven by personal gain or sponsorship deals rather than a genuine understanding of the investment's potential risks and rewards. Consequently, blindly following celebrity stock picks can lead to significant financial losses if the touted investments fail to perform as expected. The phenomenon of celebrity-endorsed stocks can sometimes create speculative bubbles, driving up the prices of certain investments artificially. This can result in heightened volatility and increased risk for investors who may be drawn into the market based solely on the endorsement of a celebrity. It's essential for investors to conduct their own due diligence and research before making any investment decisions, considering factors such as the company's financial health, market fundamentals, and long-term growth prospects. Relying solely on celebrity recommendations without performing proper analysis can expose investors to unnecessary risks and potential losses in the stock market. 4. Penny stocks. Penny stocks, typically defined as stocks trading for less than $5 per share, attract investors with the allure of potentially high returns in a short period. However, they are notoriously risky and speculative investments. Penny stocks are often associated with small, unproven companies that may lack liquidity, transparency, and regulatory oversight. As a result, they are susceptible to extreme price volatility, making them vulnerable to rapid and substantial price fluctuations. This volatility can be exacerbated by the relatively low trading volumes of penny stocks, which can lead to wide bid-ask spreads and difficulty in executing trades at desired prices. Also, penny stocks are more prone to manipulation and fraudulent activities due to their lack of regulation and oversight. Unscrupulous individuals may engage in pump and dump schemes, artificially inflating the price of a penny stock through false or misleading information, only to sell off their shares once the price has been driven up, leaving unsuspecting investors with significant losses. Additionally, the lack of reliable information and financial disclosures from penny stock companies can make it challenging for investors to make informed decisions. Investing in penny stocks requires a high tolerance for risk, a thorough understanding of the market dynamics, and careful due diligence. For most investors, the speculative nature and inherent risks of penny stocks make them unsuitable for inclusion in a diversified investment portfolio. So, when considering investment or saving opportunities, it's crucial to remain vigilant and aware of potential pitfalls, especially in the context of non-traditional investments like penny stocks or celebrity-endorsed stocks, and even storing cash at home. It's crucial to adopt a cautious, informed approach. Here are a few tips to keep in mind. First, conduct thorough research and due diligence before investing in any asset, and seek advice from trusted financial professionals. This includes analyzing the company's financial health, market trends, and potential risks. Secondly, always be skeptical of investment recommendations from celebrities or influencers, as their motivations may not align with your financial interests. Thirdly, be wary of investment advice from unreliable sources, especially those promoting get-rich-quick schemes or promising guaranteed returns. Always verify information independently and seek guidance from reputable financial professionals if needed. Fourth, diversifying your investment portfolio across different asset classes can help mitigate risk and protect against market volatility. Lastly, never invest money that you cannot afford to lose, and always be prepared for the possibility of losses when investing in speculative assets like penny stocks.